So for me, that's the most critical part. Nailing down your go-to-market strategy, understanding your customer funnel is the most crucial part to come up with a viable financial strategy for the startup. Your platform is going to keep building upon you. It's like a foundation that keeps building. So you need to test from the beginning. So I think that brings down burn rate a lot for SaaS founders in my experience. If they hop on early testing, if they get early feedback and they improvise the product based on customer feedback. You could have simply gone to your founders in your community and tried testing the product right there to get the feedback, instead of making something that was ready 100% and then trying to go at top of the market and launching it and then getting feedback and then reiterating and then improving on product. Cash flows tend to be very important, especially when you're pre-revenue, because naturally you need to know where those black holes of cash are present during the course of your GTM and then launch and then roll out, that you need to fill. Obviously, you need to burn cash in order to acquire those first clients. For that first push and that first burst of client acquisition, you need to burn cash. A certain amount is required. Test small, figure out how much ad spend is getting you traffic. How is that traffic converting to orders? How are those orders sticking? What's the churn rate? How long is the customer lifetime? You don't need to have a product down for a year, 2 years, 3 years to know all of these metrics. You can still know with 3 to 6 months of beta testing.
Okay, so Saadia, let's get started. So tell me, what are you up to?
So currently I am up to a handful of things, actually. I'm working in stealth on a tech startup of my own. So can't disclose too many details, but I'm kind of, when people say that consultants don't know the grind that founders go through, I very much know, because I'm one myself. But my main hustle right now is helping startups and scale-ups visualize their financial strategy. So many of the founders that I work with, when they come to me, whether ideation stage, whether pre-revenue or whether post-revenue, they have a lot of ideas and they have a lot of thoughts in their head, but they don't really have it all sorted. And I help them quantify their entire concept.
Okay, so that's it. So you are helping them quantify all of their concept. How does this process look like? Where does it start? Where does it lead to?
Right. So it begins, like I said, it could be several different stages where you would find that where a startup would think that they need assistance of a strategist. But so it happens that most people come to me when they're fundraising and when they need a financial model. So that's when they think of somebody who could put together a spreadsheet or Excel sheet, make their business model on Excel, and then present it to investors. Again, like I said, there are some clever people who come to me at ideation stage. So like when they are conceptualizing their product and they are thinking of a startup, they want to know that the time, resources that they're putting towards a concept, is that viable or not? So there are like multiple different stages depending on what a founder's mindset is when they come to me. Once they come to me, I hop on a detailed, and we decide to work together. I hop on a detailed call with them with a questionnaire that's specifically designed for around their industry, around their concept, to extract as much information as I can about what the concept is about, how do they intend to monetize it, how are they, what are the revenue streams that they're looking at, what are the core cost features that they would incur, what's the project runway, when do they become profitable. And we brainstorm several different strategies. And then I take this discussion and I literally put it across a spreadsheet so they can visualize in number form whatever it is that's in their head.
Okay, so let's just talk about the spreadsheet. and you're working with a startup, what basic essential components of that spreadsheet should be there? And yeah, just go deeper into that.
Okay, you mentioned like that you're into developing go-to-market strategies for SaaS businesses. So it starts from there for me. So when I discuss a concept with a founder, I ask them like, what's your go-to-market strategy? How are you attracting those leads? How are you acquiring those clients? What are the costs associated with acquiring those clients? And then that is, for me, that is the core component, because what happens is that when you talk about and I get, I mean, I know consultant get bashed so often on several different platforms where they like, we are not regulated, or consultants or finance professionals in VC and early startup stage, they are not vetted. But the thing is that how do you vet someone for something that is so vague, like a pre-revenue startup? So when my clients come to me, I help them clear that vague out of the equation, and we nail down that how are we getting those clients who are eventually going to become revenue streams for us. So for me, that's the most critical part. Nailing down your go-to-market strategy, understanding your customer funnel is the most crucial part to come up with a viable financial strategy for the startup.
And you've figured out the cost this way. And how, which KPIs determine, okay, that this startup will eventually make money? Because most of the startups, SaaS startups, burn a lot of money before they become successful. So which KPIs do you envision? Okay, this ratios have to work these before this model actually becomes successful.
So they are, there's no right answer to it, or like there's no one size fits all answer to this, because when you talk about a SaaS or even a B2B SaaS, there's so many different versions of it. So there are the marketplaces, then there are enterprises, then they are B2C, or that they are small cap B2B. What I would say is that the most that we when we say we were burning cash is the most amount is that we burn, or founders burn, is when they keep on investing on product development without testing out with real actual clients to find that product market fit. So I always say to my clients that go for the least costly option, go for like low code option, and get the product, get your concept rolled out, get some testing done, and reiterate. You will constantly, we in the SaaS space, we're constantly reiterating. Meta is still coming up with newer features across all of its platforms. So it's an evolutionary journey for every founder who's in the SaaS space. So don't think that you're going to create like this perfect product and then everything is going to be perfect. And it's not a plant or machinery that you acquire for once and then it's going to service you for the next 10 years and then it's going to depreciate and go away. Your platform is going to keep building upon you. It's like a foundation that keeps building. So you need to test from the beginning. So that's, I think, that brings down burn rate a lot for SaaS founders in my experience. If they hop on early testing, if they get early feedback, and they improvise the product based on customer feedback.
Okay, and obviously, the most of the startups will be going to the VCs and showing all of their projections and financial models. What VCs would like to see in those financial models, and do you have any tips or recommendations over there?
So VCs are they're the people like you and I, but they're shrewd people. That's the only difference between a typical starry-eyed founder and a shrewd VC. So I would recommend that when any startup founder is putting their putting their number across a VC or an angel investor, you should know that how are you getting those clients? Like I said in start of this conversation, that is the most that's like I've seen conversation make or break at that question. Okay, you've assumed this number of users, but what's the homework behind it? Or the TAM, SAM, SOM, it's absolutely like a house of cards for most founders. Like, they assumed that, okay, this is going to be it, but there's no solid research behind it. At times there is wishful thinking behind it, and again, there's no product testing behind it. So it needs to be like a combination of your research, your product market fit, and your testing.
Okay. And you talked about TAM, SAM, SOM, all of those numbers. So what advice do you have to actually come up with the best possible numbers over there?
I'm going to be so political here and say again, no, no one size fit all or no right way. But
Mhm.
but the perfect way to do it is nail down your funnel. Do like a bottom up. Find your customers around you, because most often founders create a product around a problem that they themselves are experiencing. That's like 90% of the SaaS solutions are something that a founder experienced in their business themselves, and they felt like this problem needs a solution, and the idea clicked with them, and then they got on board and started the project. And more often than not, it's people like them. They're surrounded by those people who they're solving the problem for. And if they go upwards from there, so how's the funnel? We usually come top down. So we're like, okay, my product is rolling out in UK, and then I'm going to, going for these businesses, and then I'm going for this size of sales team, and then I'm going for this. No, go top, from bottom up, and that's how you solve your customer funnel, and that's how you nail down your SOM. You don't necessarily have to come from TAM, SAM, and SOM.
Okay, so you talked about the top-down and bottom-up approaches. Can you please elaborate more for the users and with some examples? Okay, this is top-down and this is bottom-up. Which one is preferred? Which is one is not? Yeah.
Sure. So an example of top down would be that, like I said, you would assume that, okay, my product is rolling out in a certain geography, for example, UK, and you feel like I'm solving a problem in UK for B2B. Now you think that this problem is 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 prevalent in the businesses, mid cap SaaS, and they really need this product to solve this issue. Now you have started approaching the clients from this level, right? Whereas you could have simply gone to your founders in your community and tried testing the product right there to get the feedback, instead of making something that was ready 100% and then trying to go at top of the market and launching it and then getting feedback and then reiterating and then improving on product. So start here. Start with 10 founders, start with 5 founders, test your product, know your people, and then go up the ladder and then find out that how you can expand. So then expand cross functionally. So if you're solving a solution for, say, finance division, see if you can apply this solution to HR divisions of a firm. See if you can apply it to the marketing divisions, and then across the spectrum, you could find opportunities to expand rather than going all the way to the top and then coming down.
Okay. So in terms of like, if Toby, you're presenting your financials to the VCs, so which you can say the balance sheets, the income statement, the cash flows, which one is the most important one, and which one, or all should be there? What do you recommend over there?
I think that cash flows tend to be very important, especially when you're pre-revenue, because naturally you need to know where those black holes of cash are present during the course of your GTM and then launch and then rollout that you need to fill. Obviously, you need to burn cash in order to acquire those first clients. For that first push and that first burst of client acquisition, you need to burn cash. A certain amount is required. But and a lot of times just looking at P&L is not sufficient, because it doesn't take into account any of your balance sheet expenses like web development. So you need to look at cash flow is more representative of what's the situation of cash in the business, where you're running out of it, how do you need it. So you don't need, if even if you get like a $1 million check, you don't need the entire $1 million on day one anyway. So you can break down your activities in such a way that you plan your investments and you plan your checks along the way, and the entire round doesn't have to close out at the same time.
Okay, that's awesome. So you've written, there are accountants, there are modelers, and there are people who strategize and analyze. So is there any preference for between the roles? Which one do you like favor?
So I don't want the accountants of the world to crucify me, because I'm not one, and I'm not after them because they're wonderful people. But they're accountants, and that's what they do. They manage the books. They make sure that we follow the regulatory and compliance and compliance requirements to the T. They, unfortunately, we try to burden them with making these extensive strategies or analyzing businesses to accountants whose focus is something different. It's like you are asking, you go to a doctor, right? And you go to an ophthalmologist for your eye, right? And you go to an ENT specialist for your ear. You're not going to go to an ENT and insist that, no, you are a doctor, aren't you? You've studied medicine, haven't you? For 5 years, you have studied medicine. Please look at my eye. You must look at my eye. You're not going to do that, right? They're both doctors, but they have their own respective expertise. So don't go to accountants and ask them to construct models, because they are just going to do that, to construct a model, make a spreadsheet, put your numbers in there. That's not what you want. What you really want, or what you really need, your business really needs, is sit down with somebody who will analyze your business model, who will tell you or brainstorm with you how to monetize those revenue streams, how to better optimize your product mix, if there's one, how to best manage your cash flows, like when should any certain activities, marketing activities, when should they be taking place?
Yeah, so Saadia, so obviously it's difficult to find those analysts, right? So for a bootstrap, like a real early startup founder who's a techie, and they have to present a business plan, just tell them what they should be focusing on, what area should be focusing on, and how can they come up with a business plan?
Okay, sure. So yes, you are right that for bootstrap founder, it's very difficult to get consultants on board, because naturally they're working with very slim budgets, and with lean budgets, you don't want to be, you can't expense on something, you splurge rather on a consultant for everything. I would still say, not because it's something that I do, that your time and your money as a bootstrap founder that you're investing into your business, you deserve yourself this expense. Like, seriously, do it for your own self. You're your own biggest investor. So don't deprive yourself of this. And what, however, they could still do if they can't put up the cash for hiring a consultant, is sit down with a very clear head and think about that. Where are they getting the first 10 customers from? Who are they? Get a wait list in order. Get a pre-order list, if they may. And then start from there. Build their customer pipeline from the get-go. Before they have an MVP, build a customer pipeline. Start talking to people. It doesn't hurt to have conversation. Start talking to analysts or strategists like myself. And whatever it is that you put together, hop on a call with the strategist. Take a discovery call, 15, 20 minutes. Ask their opinion, like, what have I put together? What do you think about it? Nobody's going to charge you for that. And you're going to get plenty of great advice anyway. So this is what I would suggest to founders who are putting together their models themselves for fundraising.
And you keep on mentioning, and obviously you mentioned the podcast, and it's just also written that in the early stages, nailing your customer funnel is your north star. So
it's my favorite topic. I love
Yeah,
talking
fair
about
enough.
it. I love,
Yeah, just
yeah,
please.
yes, sure. So again, like I said, so many people assume like, okay, I will have 300 users in the first month. So many founders, they just plug random numbers in their models or in their growth numbers or in their projections. Like why? Where? Where are these 300 customers coming from? What's your ad spend? What's your social media strategy? What's your influencer marketing strategy? What's your where are you getting? Are you have do you have partnerships going on? Do you have any recommendations that are coming across from influencers in the business space? Like how are you getting those first 100, 200, 300 customers? So getting that right is imperative, and that doesn't mean that you go and blindly spend like 10, 20,000 dollars on customer acquisition. No. And that's what I mean by nailing your customer funnel. Figure out, test small, figure out how much ad spend is getting you traffic. How is that traffic converting to orders? How are those orders sticking? What's the churn rate? How long is the customer lifetime? You don't need to have a product down for a year, 2 years, 3 years to know all of these metrics. You can still know with 3 to 6 months of beta testing.
And in terms of pre-revenue companies, so this funnel and this maybe the imaginary funnel that will exist, how do you handle those numbers?
So again, I partnered up with several different people in across the industry. So I partnered up with social media company agencies which have the expertise to nail down what conversion rates are taking place across certain geographies, across certain demographics of clients for certain products. So I don't only just work for B2B SaaS, but I also work for example, I've recently concluded a project for a homegrown skincare brand based out of Middle East, and conversion rate for them were very different for what a conversion rate for a B2B or B2C SaaS would be, because this is not a product that you just click and download an app on your phone and start using. This is a product where production needs to go behind the scenes, and this is a high involvement product because somebody is actually using the product on themselves, for themselves. It's like a highly personal decision that they're making. So I do extensive research behind the scene with other experts to figure out that what a certain industry's conversion rates, what their go to market strategies should be, and then that's where I come up with these funnels and strategize what should post revenue life look like for this particular startup.
So I think growth is a huge element over here. So just talk more about growth in terms of numbers, as to, okay, this is acceptable, this is not. Yeah.
Sorry, please, if you could just
Yeah.
rephrase your question.
Yeah. Yeah. So as I was asking in terms of every startup needs to project growth, right? And so obviously on Excel, it's very, very easy. I mean, you can do 20,
Yeah,
30, 40,
5%,
50%.
10%, yeah, 20%. Yes, exactly,
Yeah, everything's
exactly.
there. Yeah. So what have you seen, like the best practices are that this kind of growth numbers are fine, these are not? What advice would you give to early founders over there?
Okay. So if you are, if everything is perfect, if you are in the perfect world and you have optimized all your resources, you're working on a very lean model, but you're also getting the most out of the resources that you've deployed in terms of human resource, in terms of investment money that you have deployed in there. Uh, Ideally, a B2B or B2C SaaS would grow by about 10 to 15% in the first year. And then they would have this growth explosion and grow by 20%. Now, see that a 10% growth on 100 user and then a 20% growth on a 2,000 user is going to look very different in absolute numbers, right? So then subsequent years, second and third, 20%, and then it kind of tapers off to about like 7 to 5% for year 3 and beyond. And that's where most VCs or early stage investors or angels, they look for exits on startups.
Okay. And you talked about B2B and B2C, and how do the numbers and the financial projections change once you're talking about B2B SaaS or B2C products?
So again, it's the difference lies in go-to-market strategy, and the business lies in the difference lies in the go-to-market strategy and the ticket size. So some B2B solutions are very small ticket size. Calendly is like $10, $15. It's a small ticket, a small involvement. So something like that would have high growth numbers. But if it's an enterprise solution that is, for which you have to pay upfront for about a year, and that costs like $5,000 for a year, that is going to have a lower conversion rate, and that is going to be different, and that it's going to be treated differently. A B2C would have a different strategy because it would have a freemium version, and then it would have premium version. What I do, and what I aim to do rather, is when I sit down with the founder and when we put together all the information that is relevant to their concept, we explore all the ideas to get the product in the hands of the customer first. So whether it be, offering them, free trials or freemium versions, or make a low ticket and high ticket version of their offering wherever it is possible. Again, there are always exceptions where it's not possible and where we can't do that. But the similarity in across all of these is that you get the product right in the hands of the customer. And the difference is that, well, there are different tickets, different go-to-market strategies. That's what make each of them unique.
Okay, so in terms of, let's just talk about the pricing and valuation of startups. So how do you come up with the valuation of, okay, this company is worth this much, or especially for the early stage?
This is like a topic that, that can be talked about for hours, because there's, again, no right answers, and there are going to be so many different concepts out there. I mean, there's just no one valuation method out there anyway. So to give you a little background, I come from a standard investment analyst background. My experience is in asset management and banking. And when I started off my career 15 years ago, there was a lot of DCF analysis that we used to do to value companies and value stocks, which is still relevant for stable growth companies or listed companies today, and companies who have high number of assets. It's just not very relevant for SaaS companies per se. Our space has become such that we don't really have any physical assets, but we have like humongous revenue growth. So how do you value these companies, right? You don't really have any liabilities either. You don't have any assets. Like, what's the matrix for this business? This is where valuation experts and VCs and overall, like, the industry came up this idea. And by the way, this still happens in the standard industry as well, that we use a multiple of a revenue to figure out that what a company should be valued at. So we take a profit or revenue of a company, and then we multiply it by a 5x or 8x or 10x, whatever is the industry standard is for comparable companies or similar companies that have had a transaction in recent past. And that's how we normally value a startup. So if you go to any analyst, this is the best they can do for you. Like, they can understand your business model, create your business model onto a spreadsheet or Excel, and quantify those concepts, and then they would take your projected revenue, take a multiple. It's now it's the quality of work that goes behind it. So, like, how good have they been with projection? How solid have they been with their research? How solid have they been with their research so as to come up with comparable companies? Like, where have they done their research to find out, like, X, Y, and Z companies have been sold in recent past at this multiple? You need to do your research thoroughly to be arriving at that multiple. It can't be like a ballpark that, oh, all e-commerce platforms, they go for 8x, or oh, all B2B, B2C SaaS go for 10x. It can't be that. It varies across different geographies as well. So you need somebody who knows the business, who knows how to do that relevant research, who gets you those right multiples, and then gets you that valuation. However, the valuation that an analyst gives you is probably not going to be the valuation that your investor accepts. This, because it's the starting point for a discussion. It's a placeholder. It gives you an idea. Otherwise, if you're a startup founder and you've done all your maths on the back of an envelope, what would you say to any investor or VC or an angel that what's your revenue like, or what's the multiple like? This work needs to go behind it, because otherwise you can't have that placeholder to start the discussion. Of recent, there has been a lot of hit by industry experts that say that, oh, the analysts just give you a number and the VCs never accept that numbers. That it's not meant to. They're not going to. If you've seen Dragon's Den, you would say that the founders come up and they say, oh, I'm looking to get 50,000 for 20% of my equity. So there's always negotiation. The dragons always negotiate, don't they? This is exactly what happens in real boardrooms or VC rooms or meeting rooms where these discussions are happening. There is always room for negotiation, and that's what term sheets and deal making is all about.
So you mentioned there's a price multiple. So there's one way to come up with valuation. And you mentioned the DCF. Is that relevant or is it not relevant?
It's not for our space anymore, no. Because then we either look at revenue multiples, or we look at a scorecard method where they rate like what the founder's track record is. Do they have any previous startups that they've exited? Do they have relevant experience in the industry? So on and so forth. So that there's certain scorecards as well that, again, every investor is going to have a different one if they do. And every analyst cannot possibly have it for all the investors. So again, we have to make do for our founders with the valuation that we come up with from revenue multiple perspective.
Okay, so there are companies that are built with the intention of exit, right? And there are companies that are built with the intention to get to the IPO. Does that change in terms of the way you're projecting and you're presenting your business plans?
Mostly early stage startups. I would add another type of company over here as well.
Okay.
And sure. This is also a sort of I'm seeing a lot of these recently, in fact, and I'll tell you why. So these are lifestyle businesses. The founders are making something that resonates with them, and they don't want to exit the business. They want to grow with the business, and they're not super aggressive about it. So their investment asks aren't massive either. And they are not going to VCs either. They are happy to take small ticket investments from friends, families, or maybe an investor who aligns in their interests. So who has a similar idea, who has a similar passion for similar thing as they do. I'll give you an example of one of my clients. Rideaway is a very niche marketplace. What Rideaway are doing is they have a marketplace based out of UK, e-commerce marketplace, where they are selling adventure tourism for bikers. Now, this is like as niche as you could get. Adventure tourism is a niche, and then bikers are further niche. But the founder, Justin Davey, my client, he is super passionate about his idea. He's worked he sweated off this idea for the last 6 months, day and night, working on every aspect of the business himself. And he doesn't plan to really exit it. He plans to carry on with it as a lifestyle business for as long as he can. There might be a point where expanding into different geographies or going into different verticals makes it so huge that he won't be able to continue having it as a lifestyle business. But for now, this is his plan. Like you said, there are companies that are, that have a strategy in mind to exit within 3 to 5 years. These are mostly companies that have product led growth, so they don't really have a suite of products that they could expand on a bank of, and they have a really good one product that they think that maybe like a HubSpot of the world or a Salesforce of the world could potentially acquire in 3 to 5 years time, or a Meta, for instance, could acquire, and then they would be more than happy to sell it as a product, or become a product manager in that bigger company for their particular startup. Um, so that's for very early stage or pre. That's where those are the early stage and pre-revenue companies. Those who are aiming for the IPOs are more sophisticated and they're further into their startup journey. So they are perhaps they've raised a Series A and they're going for Series B raise. And they have, attraction and revenue and product suite and a very strong community of users that they want to keep on building, and they want to keep on coming up with solutions for them. So that's like a different category of business altogether. So this, in my experience, is like, depending on founders' aim and depending on what they want from their business or how their business originated, it all is, there are all these different pieces to this puzzle.
Okay, that's great. So in terms of, so there's a concept like pre-valuation and post-valuation. Can you please tell the customer users about it, as to what those concepts are and what should they really know about those terms? And
so what I have, before I go into pre and post money valuations, I'll just touch upon this, that a lot of founders who come to me, whether they're tech based or whether they are working on a passion project, obviously they come to me because they don't have the expertise in the field of finance, or they've not studied finance or numbers per se, and that's their weak point. And what they often struggle with is understanding that when you get a revenue number, a projection number for 3 years or 5 years, it's a forward looking number. It's something that is going to happen in, say, 2025 or 2028. And now you're standing in today and you're asking for money today. So what we need to do is we bring back that number from the future. So you have to be, like a bit of Marty McFly situation, and you have to discount back that number. So they really struggle with understanding this concept, like, what is this discounting happening? Like, how do I come to arrive at this number? So that's one thing they struggle with. And that's one thing I help to, sort out for them. I take them through it, that, this is something that's in year 5, say, for instance. And currently, the investors are seeking 25 or 30% return on their investment because they're assuming very high risk when they're investing in a pre-revenue startup. So they demand a very high return economic concept, which is why we need to discount it back by 30% to today. So just like 100 rupee or $100 is not going to get you, the same things in 3 years' time. It's the same logic applied backwards. And after some back and forth, we do come across like, okay, fine, this concept now makes sense. The other, obviously, the next one is where we get, questions is obviously pre-money and post-money valuation, and what's the deal there. So you're a startup and you're something before that money, right? So there's a parallel universe where you don't have the money, and you continue to bootstrap whatever you created, and you continue to grow it. But that traction is not going to be the same. That boost is not going to be there without the cash flow that you need to build on your technology and get your customers. So that's where the pre-money and post-money valuation kicks in. So with what your startup would value if it continued at the same trajectory without any influx of cash, and should we put that cash in, what company would be created with that cash, and how that gives you an improved valuation. This is, in a nutshell, the simplest description or the simplest explanation of this concept.
Okay, that's awesome. So, Sadia, somebody has to really learn about the stuff. Which, I mean, certain few books or you recommend, or any other channels they should go to educate themselves to get to a good understanding level.
First things first, I would say get on a call with me. I'll be happy to
Okay.
explain this concept to anyone and everyone 100 times over.
Mhm.
More than happy to do that. Apart from that, I would say that Y Combinator has great resources around valuation. And now you asked me about books, but I see that most of us don't have the patience to go through and stick around the books, let alone for a topic as boring as finance and valuations and number crunching. So just start off with listening to the Y Combinator lessons or startup classes, and they are a wonderful resource out there.
Okay, awesome. So, Sadi, anything that you want to add? Maybe I've missed, so that will add value to the end users.
I would say that I think I mentioned something that about why I think the bootstrap founder. There's so many people are choosing to bootstrap their businesses and going into lifestyle businesses. I would just like to expand a little on that.
So,
Um, we're in very difficult economic time. I mean, we're like, it would have been easier if we had hit a recession outright, because that means you've hit rock bottom and then the only way is up. But we've not, that's not happened. This is 2007 has not happened, 2008 has not happened, and we've avoided the recession for now. And what most startup founders don't realize is that it significantly impacts our industry the most. It's not the industry that's borrowing from the banks or from the traditional avenues who get impacted by it, but it's us, because we were getting the money when it was all free. We were getting free cash when there was everybody was turning cash and printing cash, and there was 0%, and the sky was the limit. That's when we were getting money. And now nobody wants to put their money in risky assets like us, because they're getting 5-6% risk-free return. Would they want to assume any risk at all? That's still higher than inflation. I mean, today UK's inflation has come out to be 2%, and the interest rate is 5%. That's 3% gain for me as an investor. Why would I want to assume the risk of a risky startup? So what has happened is the clever people have realized that instead of wasting time and going through the struggle of fundraising and going through VC, because there's a certain profile that raises from VCs. They're either going for small checks to for a moderate pace growth and just kind of like extend their lifetime through these difficult times, or they're bootstrapping and they're improving the quality of work that they're doing, or how they're getting to their customers, or being just super smart in how they're executing things, whether it's technology or whether it's client acquisition or whether it's just allocating other resources. So the quality of startups that are developing now in pre-seed seed level or have survived to series A in these times is going to be so much like significantly higher than what we've seen previously. And this is what is going to set us apart from the startups that we've seen in the last 5 years. And we're going to see some really quality work down the road. But for now, it's a difficult time, I understand. But what businessmen need to understand, or what founders need to understand, that economics, it impacts us significantly as well. So keep yourself informed, keep your eyes open, learn what is happening around you in other industries or in other spaces, and make your decisions holistically.
okay, that's awesome. So, Sadia, where can people find you?
You can find me on LinkedIn. I'm Saadia. and that's my preferred social media handle. I'm seeking to launch myself on Instagram, but I'm just not. I'm too much of a millennial, I think, to be there. So yes, that's where you find me.
So, Sadia, I enjoyed a lot. So, I guess this will be a great conversation to be shared. So, we usually take a week to upload and edit and all of those. So, whenever we plan to do, we'll let you know. So, as to you're ready. And I appreciate all of your time and energy. So, yeah, we should stay connected.
Thank you, Saad. Yes, it was a pleasure. It was definitely a great conversation.
Okay, Sadia. Have an awesome day. Thank you.
You
Take care.
too. Bye.
Bye.